Hey there guys, welcome to this video. Today I decided to make a video about my A plus model. It's a strategy that I use personally, and I use it every single day looking for these rules and confluences, and I'm going to show you exactly what these rules are so you can start trading this model. So the first rule is identify resting liquidity. Obviously that's very important. You need to have a directional bias in the morning. So when you open up your charts, first thing you need to do is identify where the resting liquidity is. That could be determined by relative equal highs, relative equal lows, the London low, London high. Those are key levels that I'm paying attention to for price to draw to. So what I mean by that is when you go into your chart, identify where the relative equal highs and relative equal lows are. And also I'm looking at where the London and Asian low and highs are as well. So here you can see we have relative equal highs before the opening, which is at 9:30 a.m. Eastern time. So before the open, here we have relative equal highs. To me, this is buy side liquidity. And down below, we have our London low right there. But notice that we have another low that's relative to that. To me, that's relative equal lows. That's a key area that I expect price to draw to. So when we have two biases, when we have buy side and we have sell side, wait for one of the liquidity to be swept and then target the opposing liquidity. Okay, so now I have a bias coming into the morning where I'm paying attention to buy side and sell side, and then I'll wait for one of the liquidity to be swept to then target the opposing liquidity. And here you can see in this example, buy side is swept. As we open, we take out buy side to then run to sell side. So once buy side is swept, now we want to pay attention to sell side liquidity. So our second rule is wait for a shift in market. That's pretty key, is you want to wait for a change in state of delivery to the downside if we're targeting sell side liquidity to determine now that price wants to run to that draw of liquidity. So here you can see once we've swept buy side liquidity, we then displace lower, confirming a shift in market. Once we've received a change in state of delivery to the downside, we now want to pay attention to our PD arrays. So that now applies to our third rule. Pay attention to insufficiency. What do I mean by that? Well, it's actually very simple. A lot of traders look for fair value gaps, and here you can see a bearish fair value gap was formed right here. We call this a SIBI, a sell side imbalance, buy side insufficiency. So a lot of traders think that when we create these fair value gaps, they want to see price retrace and fill the entire gap. Well, that's basically the opposite of what I'm looking for. I'm looking for price to leave that insufficiency unfilled, meaning that I don't want to see price trade inside that gap. I prefer it to stay open or just barely trading that gap like it does right here. We call that an institutional order flow entry drill. That's exactly what I'm looking for, because this tells me that we're expecting a stronger sell side delivery, and that's when I want to be trading in the market, when we have more of a energetic quick move of delivery and price action, not these choppy high resistance liquidity runs, right? So once we've traded inside that gap and then we displace away from it, breaking below this bearish order block, that is the confirmation. Now I want to get in this trade. Once we've confirmed that price never trades to that consequent encroachment, that's what I mean by paying attention to insufficiency. Pay attention to the levels of that gap. Meaning pay attention to that consequent encroachment, 50% or midpoint of that gap. If price never trades to that midpoint and only trades barely in this lower quadrant and then runs away from that gap, that's exactly what you're looking for. That gives me the confirmation and the conviction of this sell side delivery. Notice that we've created another bearish fair value gap right there. That's the gap that you want to pay attention to for an entry. Or you could use this bearish order block as an entry as well. You can use both. I prefer to use the order blocks, but here you can see price create that SIBI inside this bearish order block. So to me, this is a nice fair value gap for an entry. That would be your entry to then target sell side liquidity. And it looks something like this if you're using that fair value gap. And you would keep your stop at that 50% of that gap, expecting price to not trade to that fair value gap and leaving that consequent encroachment intact. And then trade to sell side liquidity, which is those London lows. So your entry would look like this. You would enter at that fair value gap with your stops above the candle of that fair value gap, and you would target sell side liquidity. All your confluences, all your rules apply to this model. We first identify buy side and sell side. Once we don't have a strict bias, we wait for one of the liquidity to get swept, and then we target the opposing liquidity, which was sell side. Then we wait for a change in state of delivery. Once we've confirmed a market structure shift to the downside, we then pay attention to insufficiency. We see price treat this insufficiency with respect, meaning it never trades to that constant encroachment or above. It only trades in that lower quadrant barely to then displace lower, creating another gap for an entry or that order block. And then we target sell side liquidity. This is exactly how I use my A plus model and how I trade every day, and the rules that I apply to my model every single day. So if you guys want to trade live with me for 7 days free, I do have the link in the description below. Be free to go ahead and join me for 7 days, and I'll see you guys then. Take care.